Hey,
Hey everyone, Ryan here with RyanBolton.com, local mortgage expert. I am doing another Q&A video here. I really enjoy doing these. If you have any comments or topics or suggestions for the show, I'd love to hear from them and add another video, whether it's a full-blown topic video or educational video, or whether it's just a quick Q&A. I'd love to have your feedback on that, so please answer or ask any questions that you have. So jump back on Quora again here. It's a great resource to answer questions. I'm on there all the time. I've really just enjoy jumping on this website and answering questions. So I've been doing it like crazy and just thought it'd be fun to actually video those answers or see if that would help you as well. So the first one I have here is, what are some of the hidden fees that may be involved when buying or selling a home? Now, when it comes to the lending side, that has changed dramatically. There's a loan estimate, or what's known as an LE, that is issued at the beginning of the transaction. Those fees are within a 10% variance. Some fees can't change at all between the loan estimate and the final disclosure, known as a closing disclosure, which is often called a CD. So that's not a compact disc, it's a closing disclosure. Since the '08 crisis, one of the big regulations that changed was called TRID, that required these standardized disclosures. So, and there's a comparison between the loan estimate you get at the beginning and the closing disclosure that you get at the end. There's only certain fees that can change, and only up to 10%. There are a couple like the recording fee or certain government fees that can change whatever they need to, but almost everything has that 10% cap, and some of it cannot change at all. So you get the loan estimate, then you have to have the closing disclosure not issued the same day. So let's say you get a loan estimate at the beginning of the transaction when you first get your application, then you get the appraisal, you get other documentation together, you lock your interest rate. They will send you an updated loan estimate if anything does change within those things. Then the final closing disclosure has a 3-day waiting period before you can sign your loan. So it really slowed down, made it more accountable to the quotes that mortgage lenders give. And this is across the board. It's the same form, whether you use me, whether you use Wells Fargo or Chase or anybody out there. They all have to use this same standardized loan estimate and the same standardized closing disclosure at the end. And there again, there's that 3-day waiting period to be able to compare. And on the closing disclosure, it'll tell you, okay, here's what you were quoted, here's what you got at the beginning. And almost every time I've seen it, it's less on the closing disclosure because the loan estimate doesn't give you a lot of outs. So you have to kind of factor in maybe an appraisal review or termites or things you may not need, but you have to disclose it or you can't charge it. So a lot of times the fees on the loan estimate are actually padded a little bit between that and the closing disclosure. So what hidden fees are there when it comes to loans? There really isn't anymore. They've really made it to where what you see at the beginning is much more accurate to what you see at the end. I've been doing this since 1999, and I remember seeing good faith estimates that were nowhere near what someone was going to see at the closing table because there's really no accountability to it. You know, somebody would see the good faith estimate and they'd run it around maybe to a couple different lenders and they're like, I can't even match that. That's not even existent. And they would just go with that lender. Then they'd show up at the title company, sit down in the closing booth, and they have all their real fees show up. And they're like, well, it's too late now to really do anything. It was kind of a slam them in the booth is what it used to be called. There's actually an industry term that was a nickname, slam them in the booth, which meant once they're in and ready to sign, it was too late to really go find another loan at that point, which is just a horrible business practice. So because of that, that's where they came up with this loan estimate, closing disclosure, waiting periods, and most importantly, accountability to what you're quoting is what they're actually going to see at the closing table. So I think that's a real good change. It was a lot of learning curve when it first came out. I think it's been out for many years now, so everybody's kind of got the hang of it. In fact, there's many loan officers that don't know anything different. They haven't been in the industry long enough to know anything before the TRID or the loan estimate and the closing disclosure. So that's what I would say about getting a loan. They've really eliminated this hidden fee thing. Now, as far as selling and buying the home, now selling the home, I have a lot of people that will say, okay, I'm going to sell it for $400,000. I'm going to make $400,000, minus my mortgage loan. Well, realize there is fees when you're a seller using if the buyer is doing a loan. And typically you'll still pay for an owner's policy on that property. You also might have commissions from a real estate agent, whether it's a buying agent, listing agent, or both. You also will typically have prorated taxes. So here in the state of Utah, the taxes are due in November. If you sell your home, say now, you would owe the taxes from January to now. You'd prorate that amount. And then, so you wouldn't have to pay the taxes for the whole year, but you would have to pay it from January 1st to the day that you sell the home. Taxes are due in November, but they cover the calendar year. So they're just due then, and they're late after the end of November. So that is not a hidden fee, but that's something you need to be aware of if you're selling your home in Utah, that just because you sell it for $400,000 doesn't mean you're going to net $400,000, obviously minus any liens, first or second mortgages. You want to make sure you calculate what those are. If you need help figuring that out, you can talk to any local title company. You can call my office, and I can give you kind of a net sheet of what you'll actually make when you sell the home. I've had so many sellers that thought they were going to make more, and all of a sudden they have to bring money to the table for some reason. Maybe they've got liens or first and seconds and commissions, or maybe tax liens, or just stuff they didn't factor in. All of a sudden they have to bring money to the table, and then maybe they need to negotiate a different price on the home or work out some other deal and not have to bring money to the table. And that's been pretty rare with equity being up so much over the last few years, but it does happen. So before you accept an offer on the home, do that net sheet of what you'll actually make after those fees are associated with the sale of the home. All right, let's go to another one. Let's find another one. I had a really good one here. Let's see if I can find it again. Let's see. Where'd it go? Okay. Let's see. What are the pros and cons of tapping into home equity while still paying off a mortgage? So it depends on where the money's going to go. So if you're tapping into a home equity with either a refinance of the first mortgage or a second mortgage, like a line of credit or a fixed closed-end second, it really just comes down to where the money's going. If you're taking it, putting it back into the home, maybe home improvements to make it more efficient, or make it to where you'll stay in the home longer, make it more livable, updated, those types of things, that can be a good investment into the home. The other thing is any debt consolidation you're doing. So if you're paying $1,500 every month to all these other bills, putting it towards the loan, as long as you do something with the savings, can be a great plan. I see way too many times where people will pay off all their credit cards, 50 grand, 100 grand, whatever it is, just in all this debt. 2 years down the road, they have it all back again. So once you start closing that stuff down, you've already been used to paying that money out. What I always recommend is see where you can take that extra $1,500 or $500, whatever you're going to save per month, take half of it and get it into a savings account, or increase your 401 contribution, something where it kind of comes out of your check still, because you're already used to been paying on it for how many years. It's just a discipline thing. Too many times people will save that money every month and just get used to not paying the money out without having that money still working or still doing something, whether it's putting it back towards the loan. Maybe you save $1,500 a month, so you only have one payment now. Now put all of it towards the loan, and you'll be way ahead of the ball game in 5 or 10 years. But I still believe the first thing you need to do, if you're saving money on some sort of debt consolidation, increase retirement savings, emergency funds, something like that. And always don't do it with your day-to-day checking and savings accounts. This is probably one of the best tips I can give you. If you watch a football game, or if you watch anything, all the commercials are designed to take your money, and they're good at it. The lighting, the camera, the music, the actors, that's what they're doing. They're using all kinds of psychological stuff to get you to buy whatever product that is. And you need a buffer between that, because they're way better than your willpower. They're way better than what you can do to prevent your money from going to these things. So if you have that one step buffer, it will save you so much money, so much debt, if you separate your true savings from your day-to-day checking and savings. So what I've done is I actually have a different account with Fidelity. I have a different banking account, where I don't even have the checkbook. I don't have the debit card on me at all. So the only way I can get that money is either going down to the bank and get a cashier's check and just make it a little bit less convenient. Now, it still can get to it. So if I have a tire blowout or something happened with a car or medical or something just happened, I still got it. It's not tied up in a 401 or something where I can't get to it, but it gives me that one extra step to let a little buyer's remorse kick in, or go, I really don't want to pull this money out. It's really designed for emergency or savings or whatever it is. Now, I've used this strategy too on vacations or trips, where I'll get that money into that account instead. So it's just a little bit, like I said, just one step away from your day-to-day stuff. It's just way too easy to open up your app on your phone or go onto the website, transfer from savings to checking. It's too easy. It's not enough of a step between the two. if you add that one extra step, I'm telling you what, it's going to save you thousands. It really will. So what are the pros and cons of tapping into equity? It really comes down to where the money's going. If it's going to improve the home or going to pay off debts that can free up savings, free up investments, free up that type of stuff, do it. Because the equity is just sitting there, not gaining any interest, not gaining any value. It's really important to do it. Now, max it out? No, you don't want to go up to 100%. Most lenders won't even go that high anyway. But if you've got some equity there and it's just sitting there, I think it's a really good opportunity to take it as long as the money's being served in the right spot. So that was really a deep dive on that, but I hope you find that information useful. If you have a comment or concern or question with that, please put it in the comments below. All right, let's jump into another one. How are we doing on time? All right, only about 10 minutes into this so far, so let's see what else we got. Let's see. What are the benefits and drawbacks of buying a home through a foreclosure auction? It really depends on the home. Unfortunately, the answer in real estate really does depend. It really depends on the home. It depends on the condition of the home. Is there benefits with buying foreclosed homes? Sure. They usually can be under market value, but they usually are also more distressed. They've been a home that maybe wasn't taken care of quite as well because they were going through the foreclosure process. So to give you kind of an idea, when somebody goes into foreclosure, there's these waiting periods that are required. So if you know that you've lost your job or someone's passed away or you've gone into foreclosure, usually something pretty bad has happened with your finances. Job loss, medical, something like that. Death, that's a common one as well. So if it's something where you're going into foreclosure and you have these waiting periods, at least 90 days, then there's the selling on the courtyard steps and then going into the bank's REO, then moving out of the property. I mean, these could be months. I've even seen a year before someone's actually removed from the property. They usually aren't maintained during that time. Like, why would anybody spend the money on maintaining the house if they know they're just going to lose it anyway? So typically they do need work. I mean, I very rarely do you see a foreclosure that doesn't need some sort of work and repair to it. So that's where the benefits and disadvantages come, is what is the condition of the home. It also depends on if you're using it as a fix and flip, where you're buying it, fixing it up, and then trying to sell it, or whether you're going to live in the home long term, like it's going to be your residence. Those are all the factors you have to go into on the specific home. And a lot of it will come down to the price versus repair versus how long you're planning on keeping the home. Those types of things are what we're going to do. Now, there's a lot of shows out there that show the benefit of buying and selling these properties, but realize there's a lot more cash up front than they really show you in the shows. Stuff goes wrong. You get behind the walls, you get up in the attic, you find things that all of a sudden need more money than you thought, that sits on the market, and you're paying maybe interest on a loan or a private money loan or something like that. You're paying extra points. You've got commissions and title fees and stuff at the beginning and at the end. You just really want to make sure you have that net sheet down as much as you can. And I'm amazed at how many times I see these shows where the people made like $5,000 to do it. Well, you realize it could be 2 and 3 and 4 months they're working on this thing. Maybe they paid interest and points that they don't ever show you. That if they made only $5,000, that's not a good return on the time and effort that's been put into that home. So there's definitely benefits, but it all comes down to the home itself and the long-term plan, whether it's a keeper, a turn like a long-term rental, or whether it's a fix and flip. All right. What else we got here? That's about 13 minutes. So I always try to keep these relatively short. Can you figure out how much house you can, boy, this really is a very common question. I think I've already done a couple Q&As on this, but how can you figure out how much home you can afford? This is where you talk with a lender. Almost every lender I know is going to do a free evaluation of what you're doing. That's what we do as well. You can go to ryanbolton.com and I can give you a free idea. Whether you're buying a loan or buying a home in Utah or Nevada, that's where I'm licensed, I would still be more than willing to give you an idea what you qualify for. A lot of it will come down to credit score. A lot of it comes down to debt to income ratio. Probably more than anything is what your current income is versus your current debts, adding that mortgage to that ratio. If it pushes you over 45%, that's where it gets harder to get qualified. Now, I've seen debt ratios go as high as 55%, even 60% on some loans. And I've even seen some at 40% that didn't get approved. But generally, it's 45% of your monthly income can go towards your current bills, then towards that new mortgage. But you also have to factor in the taxes and insurance on the property if there's an HOA. So that's really a big determining factor on how much loan you can afford, is based on your debt to income ratio. So have somebody review the numbers with you. Call a local lender. You can talk with me. Again, whether you're buying in Arkansas or or wherever you're seeing this video. I really focus on Utah and Nevada, so I'd love to earn your business for those states. But I have no problem with just showing you how a loan works, no matter what the state, California, Arizona, wherever you're at, to just show you a basic idea of what you'll qualify for. Now, there can be tweaks to that. Maybe instead of putting as much money down, maybe we pay off a debt instead. Maybe we work on the credit to get the rate down a little bit. There's a lot of ways to kind of massage that number, but we can get it pretty quick with one phone call, 5-10 minutes into it. We can get you a basic idea of what your loan amount you'd qualify for. Then it's just a matter of finding the home that fits that budget. But debt to income ratio, that's a huge starting point on a pre-approval to find out how much home you will afford. All right, let's find one more good one. Let's go into another section here. Okay. Here's one. What are the pros and cons of an FHA 203K loan? How many people have heard of that loan before? Raise your hand. No. Oh, maybe one in the back there. I'm just kidding. A 203K loan is a rehab loan. There's two of them. There's a streamlined version and the regular 203K. What this loan does is an FHA-backed loan that allows you to purchase the home and build in some rehab costs to that loan. So it actually allows you to do both on a loan that maybe needs a new roof, maybe needs some updated stuff. They don't allow anything crazy major like adding a bedroom or a bath or that type of stuff. It's not designed necessarily for that far, but it's a really good loan. It's one of the few ones out there where you can buy and build in some of the expense of doing rehab on the property. So that's really the benefit of that loan. The downside is interest rates are a little bit different on that. It's you still have to put a down payment on the total amount that you're buying. But I would say there's way more positives with it. It does need to be an owner occupied. It can't be an investment property. It can't be a fix and flip, that type of financing. So it does need to be something where you intend to live in the home. And so there's some nuance with this particular loan. But the basic idea of a 203K FHA loan is a rehab loan to purchase and do rehabs. A lot of the rehab goes up to like $35,000. If it's over, it's a different type. So there's a dollar amount as well that determines which of the 203 loans that you actually are trying to qualify for. So hopefully that's helpful. Let's say it's about 17 minutes. Maybe we'll go one more here. Anybody enjoying the show? Maybe comment, like, subscribe, all that YouTube stuff. Hey, I'm new to this. I got a new microphone though. I don't know if you can see it. This has made a big difference. The audio on a couple of the videos is not great. So I'm trying to move on up and make a little better experience for everybody. All right, let's go. Let's go one more. Got off topic there again. Let's see. What is the best way to buy a house with no money down and bad credit? Well, first, why is your credit bad? There's lots of things we can do to improve the credit, which will help open up other doors. But there is, and it depends on what you define as bad credit. If you're in the 500s, that gets really tough to do 100% financing. Usually the minimum is 620. Some even go to 660. So we can get you to there. It just opens up a lot more doors. And I'm amazed that if we spend a little time working on the credit, it may be easier than you think to get the score up to that next tier, which will open up way more 100% financing options. Otherwise, you're looking at 10% down, that type of thing. So it's kind of best of both worlds. It's hard to get 100% financing and bad credit, but it's easier to work on the credit than to do a loan that's 100% financing for bad credit. And bad credit could be anything. What are we talking about? Bankruptcy, foreclosure? Are we talking just a bunch of lates? So maybe a little education on how the credit works, maybe a little budget management, maybe a little bit of tracking where the money is going. Medical can be a real big reason why credit can be bad. And that can be a little bit of a stickier thing. There's a lot of talks about having medical collections not reporting to credit or not hitting the credit score until it turns into a judgment or something a little bit further, which I would love to see that. There's way too many times I see this collection show up for a $30 copay and the insurance was just late paying and just went right to collections. I think that's ridiculous how often medical goes to collection. I mean, there's probably people listening to the video that totally agree with that there's no, and then the bills actually end up getting paid, but it still stays on as a collection. So there's definitely some work that needs to be done on how the credit bureaus factor medical expenses, because I think too often it hits collection too fast, that there can be just a little bit of time to make sure the insurance has time to pay it. Now, if it goes to judgment or goes, steps further where it's been ignored or people just don't pay it or they're disputing it or malpractice or, those types of things, that's a different scenario. But I can't tell you how many times I see $30 and $50 collections that were basically copays, or the insurance was just late in getting it paid, or it missed the billing cycle or something stupid. And all of a sudden it's a collection. It's the only derogatory on somebody's account. So it shouldn't hit the score the same way as a normal collection account. So I would say that, so the question again was the best way to buy a home with no money down and bad credit. Work on the credit a little bit. Let's see why the credit is bad, and you'll open up a lot more doors by fixing that. So that's about 20 minutes or so. So I appreciate you watching the video. Again, like, subscribe. If you have any questions I can answer, I'd love to have specific shows that are designed on the viewers and who's watching the videos. But I hope you get a lot from this. I do loans in Utah and Nevada. I've been doing loans since 1999. Love to work with you if you're looking to buy in Utah or Nevada or refinance your loan. Love to help you with that. But again, if you have any questions, regardless of where it's at, I'd love to be a resource for you. So check out my website, ryanbolton.com. It's got my phone number right there. It even has a little appointment calendar where you can see my availability and just plug in a little 30-minute phone call or whatever you need to do. It's right there on the website, right at the top. We also have a great mobile app that has a great mortgage calculator that you can apply right there if you're in those states. So love an opportunity to work with you. Again, like and subscribe, and we'll see you next time. Thanks again.